Welcome to Swimming with Allocators,
the VC podcast from the LP perspective,
with your hosts, Alexa Benz
and Ernest Sweat. You ready? Let's dive in.
Hey everyone. Before we jump into the episode, I just want to thank all of our listeners, all our guests, all of our partners for a fabulous season 3 of Swimming with Allocators. We've had a wild ride. I've learned a ton this year, and hopefully you have too. But this episode marks our last episode of season 3. Not to scare everybody, but we'll be back bigger and better. So continue to like, share, provide us with feedback, send us guest ideas, send us questions. We really appreciate our audience. We wouldn't be here without you all. But today's episode, I'm happy to say, is an amazing episode that features Elizabeth Egan, a director at TIFF, and she shares with us why she came back to TIFF after some time away. She also shared why her perspective from being both a direct and LP investor has given her an edge. And then lastly, this hurts me to say as an enterprise investor, she shares why the best training ground is actually in consumer. But with that, we're going to jump right into the episode.
Well, so happy to have you, Elizabeth. And we typically, before we start and kind of the X's and O's of what an allocator does here on our show, we love to just kind of hear the origin story. Mm-hmm. And so wanted to hear kind of how you got here, because I think it's from our prep conversation, it was so fascinating in all the different roles and asset classes you've been a part of.
Yeah. So first, thank you. So excited to be here. But I'd say quick overview on myself professionally. I've been in the investment industry for nearly 15 years, but both as an LP and a GP. And I was a Division III college athlete. And one thing to know about D3 athletes is we always like to bring it back to our collegiate careers that were pretty mediocre, very mediocre. But so I started my career at TIFF as an LP. And I would say pretty early in, I realized I was only a 1 or a 2 tool player. And like going back to being an athlete, like to be great or to be really well-rounded, you need to shoot, pass, and also play defense. Defense is very important. So I kind of knew I needed to go round out my skill set. So I went back to business school, I went to Tuck, and then I interned at a hedge fund and then worked at Breakout Ventures for 5.5 years. So I got direct investing experience both on the public side and then also the private side at a really early inflection point too. So that's kind of like the reason for being. But ultimately I boomeranged back to TIFF about a year ago. Mm-hmm. And I think there are real reasons for it. And I think really I started my career as an LP at TIFF. It kind of was my first love. Like, don't tell my husband. But I just was obsessed with the industry. And I was really obsessed with it. And it kind of became part of my DNA early on. And it's like where I really built like how to think as an investor early on. So I always knew at some inflection point I was going to come back to the LP world. So, and the TIFF mission's pretty great. So that's like a high level, but happy to kind of go from here.
Your alumni are making lots of waves these days.
Yes, we are.
Yeah. The famous graduates of Bowdoin. Now that you're back in the LP seat, do you feel that having been earlier in the food chain has changed any of your thinking?
Yes, like 100%. And the analogy I always like to use is in the venture industry, it's really common to see operators and entrepreneurs turn investors. And at a lot of firms, that's like a requirement, really for like 2 key reasons. First, you understand the entrepreneurial journey and you can add value. And 2, like you've built in an industry, so you know the nuance and kind of the forces at B in a real way. And I think like that's kind of the clarity that like coming back to the LP world is what I have of like being able to connect with GPs and add value because they're also business builders. And then to just really seeing the deals that they do and understanding like the full nuance behind it. So, so yeah, that's kind of what I've learned or like am seeing now kind of with like a more clear vision than previously.
Do you think it gave you also like a stronger sniff test? Because we've talked to so many different allocators where they say if you just go in kind of blind and listen to because everyone's impressive, right?
Yes.
First of all, that's a huge jump. Not, I don't know if I use everybody, but there are a lot of people are impressive, right? And they have these visions and you get swept away. Did it really help you on like, all right, these are the right questions I should be asking?
Yes, I'd say, like, and you guys know this, when, like, I met a lot of entrepreneurs, and I mainly focus in the consumer sector, and one thing about consumer entrepreneurs is they are passionate. They're, like, the most passionate people I've ever met and probably will ever met, but, like, they all have great decks that are beautifully branded. They all have really big customer problems they're going after and trying to solve, and markets they're trying to disrupt. Like at a high level, every pitch sounds good, but it's like unpacking like the real minutia of everything that's what makes companies successful ultimately. And it's like just like core principles of what is the customer problem? Like how obsessed is the founder around product? Like what are the like core unit economics of the business? Is there any distribution? And then is there kind of founder market fit within the problem they're trying to solve? And, you know, like going really deep into like all those layers. And it's the same with the GP side, like passionate people, they're all beautiful decks, like they all look good. They all have great strategies, unique vantage points of the market, but like it's going that level deeper. Where the sniff test like is kind of what you ultimately see. So
Yeah. I don't think we've had any allocator on who has spent as much time in consumer packaged goods brands. What is that? How does that inform what you're doing as an LP? Is this? I truly think most people listening have very little context on how to invest as an LP in physical consumer goods.
yeah. Well, I actually think consumer is the best training ground, full stop, for either an entrepreneur building something or an investor. And the reason being is like it's ruthless. Like it's just you're competing every single day, and like you have to perform on every metric, like product, brand, distribution, team, everything matters every day. And like it's a really quick feedback loop. Like if it's not good, you know. And if it is good, like there's a really, really fast copy coming, whether it's on Amazon or another competitive brand. So like I just think it teaches you really strong fundamentals. And specifically from an investor lens, like how does the story and narrative and brand and everything come together? So customers not only want to buy your product, but repeat. I just think it's like pretty fundamental. And kind of applied to this whole universe, like brand does really matter in the investment industry, specifically in venture. So I think it's a really important factor no matter what category you're in. So
I love what you said as it being a great, training ground, especially because you get this like the things you're talking about, distribution, brand. You're really getting an insight to how to underwrite kind of the human's psychology that is so important to business. Curious on how that training ground that you got applies now to with AI, being ubiquitous in every industry, and how that's changing even how enterprise and B2B solutions scale.
Yeah. So the AI world is fascinating. And I think we're just at the early innings, but kind of applied to back to what I'm doing now at TIFF. I think there's two things that they can't change. And the first is partnership and the second is judgment. And within partnership, like the whole industry joke is these funds last longer than the average marriage. We laugh, but it's like kind of true. Like specifically venture funds, they last for forever. So you really have to have trust and a real partnership with who you're sitting across the table from. And AI can't do that. And I don't think it will do that anytime soon, at least. So as all information kind of becomes commoditized, I think that's what will continue to be like a real barrier to entry and moat. And then second, in terms of judgment, machines allow you to eat faster, but they don't replace taste. And taste really, really matters in the investment industry. So I think that will also continue to be a moat as AI and everything becomes more commoditized with data.
That relates a little bit to sort of these like network effects I've heard you speak to. How do you think about like human-centric strategies for whether it's finding managers or what they excel at?
Yeah, it's fascinating because like going back to my consumer experience, network effects are the biggest barrier to entry and moat for not only consumer-based businesses but any business in any category. And what's fascinating to me is it's very true not only in the investment industry but private markets and venture capital. Like venture capital is a network-based business, full stop, and so is the LP world, frankly. And personal networks only compound over the So I think like in going back to AI, in this whole world of digitization and data, I think the network-driven referral process is only going to become more important. And like we lean on it a lot at TIFF. And I think we're going to start to lean on it even more. So
could you give us a little background on the TIFF playbook?
yes.
How are you approaching this shift?
So I'll start giving a high level just so the audience can kind of know a little bit about TIFF. So TIFF founded in the early 90s by foundations for foundations. So we were founded by the Rockefeller Foundation and the MacArthur Foundation. And all of our clients are mission-based, small to mid-sized universities, nonprofits, community foundations, hospital networks. And that's still very core to what we do today. We manage $9 billion total in AUM, and then we have $3 billion in private markets. And private markets, we have a pretty focused strategy. So we focus on lower middle market private equity, early stage venture, and then we have a direct equity book where we access micro cap private equity through independent sponsors. Okay. So that's kind of like the backdrop for where I spend time in the private market world, but I spend a ton of time in venture. And I think venture right now is such an interesting time. It's really interesting, really for two reasons. First, we have a platform shift. Everyone knows AI has arrived. But like venture is dominated by product cycles and platform shifts. So just a unique early time to be investing into this new wave. And then second, we have a generational shift too. Like everyone who's 30, 40 at a big firm is thinking about like, okay, I think there's a lot of structural dynamics for where those firms are in their life cycles and younger GPs wanting to break out and start something new. So I think because of those two things, it's been a very active time for us. And like, I think we've been thinking about, okay, structurally, how how do we position the portfolio to win in the next decade? So I'll pause there, but that's kind of like TIFF and how we're starting to think about venture for the next 10 years.
Before we get into the kind of like how you execute it on that, I think one of the realizations for me over these 2+ years in talking to allocators is, one, winning looks different for everybody. So what's TIFF's definition of like winning?
Winning. Well, I'd say in terms of performance, high real rates of return, like our clients are locking up their capital. So that needs to be justified because you need to reach a certain level to have the illiquidity premium worth it. So I think that first and foremost of high real rates of return, and venture is a lot of risk. So that's kind of how we get there and an important piece of it.
And so to that point, is it like there seems like there's a dichotomy in, or actually like I'm starting to like not say it's not so cut and dry of like this way versus that way. It's kind of a 5-otomy or 6-otomy, whatever. Like there's just a lot of different strategies. How do you guys believe you're going to get to those industry leading returns? Is it, super brands are going to maintain? Is it something in the middle? Is it like fragmented, spin out? What are you guys' viewpoint on that?
Yeah, so I think like maybe to take a little step back, this market is really competitive at this point. Like capital is abundant. Like it's no longer Harvard and Yale and like a few endowments that are investing in private equity and venture. Everyone is. And then at the same time, retail's coming too. So like everyone's going to be investing in it. Two, information is a lot more commoditized. And it's going to become more commoditized with AI. And then three, like all kind of the playbooks have been standardized really over the last 20 and 30 years as alts have become more pervasive in portfolios. So like it's tough. Like it's a tough world to be deploying capital in. So that's kind of where we come in and we think like, where's the puck going? Like, what do we need to do to continue to generate alpha and higher real rates of return? And frankly, it's going where scale can't go. And it's going to really inefficient, kind of weird areas of the market where, like where networks matter, diligence really matters. And like, you need to have networks to unpack it. And things aren't fully wrapped up in a beautiful marketing bow. So that's why, going back to where we focus, we focus on the most inefficient areas of the market. So lower middle market PE, early stage venture, and then micro cap PE. So in a really broad universe where our competitors do like a lot of different things like credit, real estate, at this inflection point, like we want to stay focused in the smaller end so we can have a shot at generating like true performance. So I'll pause there, but that's kind of the layout of how we think about where to spend time.
Now we're going to take a quick break to speak with our sponsor.
On the show today, we have our stellar partner and industry expert, Shane Goudey. He's the leader of Sidley's venture funds practice. And if you get value from this podcast, we have Shane and the Sidley team to thank for it. They make these recordings possible. We are looking forward to hearing from you, Shane. Liquidity has been a huge topic the past few years. And could you share an example of something or your team has done with the GP of late to walk us through what is finding one of these, maybe it's a secondary vehicle or opportunity fund. What does it actually look like?
I'll get to a more specific example in a minute, but just an observation kind of globally about the just activity level and just the insight and the level of discussion we're having with fund managers about getting liquidity. Now, having a more robust M&A and IPO market certainly helps, but it doesn't solve all the relative problems of the world. So I think what we've seen is a lot of fund managers establish much closer ties to the secondary fund community. Just even if it's just a diligence, a relationship establishment, just basic blocking and tackling of being a good venture manager and creating channels for liquidity. Just managing basic paths like that, even regardless of a more specific transactional structure. There's just been a lot of dialogue between the secondary world and venture capital, whether it's company side or whether it's venture fund side. People are having active discussions, and those have led to strategic acquisitions of certain strips of companies, kind of onesie twosies, exiting of positions on some things. The secondary players tend to like a bigger portfolio. They don't really look at particular sector assets unless it's AI, and then they'll buy into one asset and hope roll the dice on the crap table and hope to God that particular company is really going to make it and break it. And it has succeeded for a number of them. And obviously a lot of the big issues are the valuations that come with these transactions and what kind of real liquidity are you providing for your LPs. The more exotic things that are happening, are things like continuation funds. Those are really only happening at the very largest venture shops. A lot of that has to deal with just the fact that you may have to become a registered advisor and not be an exempt reporting advisor anymore. And there's some real costs and consequences to exploring those channels. But one real interesting transaction that I worked on, obviously client will remain nameless, is we established a level of preferred equity in a fund within an existing fund structure where we somewhat reopened the fund for two new third-party investors to inject some capital into the fund based on a particular third-party valuation of the portfolio. We made a distribution of some of those proceeds to the underlying, what were now common limited partner holders, to gain them some liquidity. And then on a go-forward basis, some of that capital would then almost reopen the investment period to be able to invest in new companies. A lot of conflicts, a lot of really funny issues, a lot of structuring, a lot of conversations to be had to do something that exotic. But those are the kinds of things that we were looking at, this time last year to really try to massage and manage a way out and gain the kind of, again, gas in the tank that these venture capitalists need to be able to, from a track record performance standpoint, to create good relations with your LPs, but create your numbers. We're looking at MOICs and TVPI and IRRs, and, we got to have, we got to put points on the board. And so, as you get launched into kind of these days when maybe the apples are a little more bent towards the ground and easier to pick, nonetheless, there's still some picking to do. And, those are the kinds of things that we were doing over the last couple of years to really try to create liquidity for our clients.
Yeah. I can think of at least one fund who they just reopened their earlier fund for additional investors recently. And it was interesting to look at the way they were positioning and messaging it. They said, we know what's in here and we know it's really good. So, if you're one of the LPs joining now, you have so much more information.
Yeah, and on the reverse side of that, you'll see, in particular, again, with the entree of this AI effect on everything, it's really starting to explore more robustly things like opportunity/annex funds, right? More when we've run out of the capital that we can spend on these great companies, it's not necessarily even to think, on the secondary front, it's almost doubling up on the companies that we do have. And so seeing that kind of extra injection of capital, because we saw a million different SPVs of all shapes and colors, in particular on big AI deals and, 9-figure SPVs being formed. It was nuts over the last year and a half, the kinds of things and the sizes of the deals. And that's only continuing to proliferate. So, whether people try to be a little more collective and pool that capital for more of a blind pool vehicle as opposed to onesies and twosies for these great deals of theirs that get negotiated to death. And but nonetheless, it's been a very interesting to see a sea to swim in for a long time and see all the wonderful sea creatures that pop up as we swim through it. It's good stuff.
Man, I would love to understand, you just said these SPVs are getting negotiated to death. How many layers of people there are to negotiate with.
Yeah, it's a lot, right? And in particular, when you get the very large institutional investors, and then it's almost like negotiating a main fund. It's the levels of, economics that they've got to pay, this management fee or that carry, or, are we tiering carry based on the performance of the company? And, let's pair with that. Yes, we're forming an SPV, but we want even co-investment on the SPV. And a lot of it is just prescient in relationship management for the underlying fund managers. And it's kind of our job to handhold them through that. Here are the advantages and disadvantages of agreeing to maybe not the best economic term, but from a relationship management, as you're thinking about forming next blind pool vehicle, and illustrating for the limited partner community about the access to the deals that you have and the willingness that you are to hear their voices in what they want. It's not just the capital, but it really is the purpose behind it. And a lot of that really is just, working with people to kind of see the forest through the trees a lot of the times. And yeah, but it's been crazy. I mean, there's been deals where it's had preferred, you get private equity concept, net IRR return hurdles, and all kinds of stuff discussed. It's been a hell of an 18 months, no doubt. It's been wonderful for me as, I represent all different investors in the venture stream, but they're venture investors, right? And we get up to the growth stage, concentrated firms or growth stage deals that start to sprinkle on them a lot of these private equity elements to them. Having colleagues who not only on the fund side, but on the deal side just get it and can really sophisticatedly add a lot of advice and content to the kind of consultation you're doing with your venture clients. These upstream deals get really complex, and having this kind of incredible horsepower here to our firm has been so accretive to our ability to really do these deals well. It's been fun.
And now back to our LP interview. One of the requests I recently heard from a listener was a little bit of historical context. Can you give us some background on sort of like why this is the area, these three you've just listed off, are kind of where you all see yourselves being able to make a dent? Like what's changed in that space, or what is it about TIFF's history that kind of aligns those up?
Yeah, I think like this is a private equity stat, but out of all the private market companies, 80% of them have revenue less than 100 million, but that segment only gets 20% of the capital versus like 80% of the capital goes to companies with over 100 million. So I think like we like backdrops like that where it's like, okay, that is by definition inefficient. So if you can go find partners who have a unique point of view or are thesis driven, they can add value and with really small companies still. And there's a very deep institutional private equity market to kind of sell into as well. So, and the same in early stage venture. We've been investing in venture since the 90s. And so we've been in a lot of the blue chip kind of venture names and have been able to really compound over time. And we like early stage because of the risk reward profile and kind of the asymmetric upside. And it's, again, like you guys do this every day, but it's where numbers aren't fully clear and you got to really do your homework. So it's very different than late stage venture where, everyone knows the ARR and the retention metrics. So, and that's why we focus there and have done well in that stage of the market as well.
How have you all, with so much fragmentation in the early stage venture, been able to really, I'm trying to get at like, make sure you're finding the right types of fund managers that have that potential to provide alpha? Like, have there been tactics of like trying to find new nodes of communities or trying to track people before they're even thinking about starting their own firm? Just curious if you have some tactics for the rest of our audience that is allocators.
Yeah, I know. It's hard. But we're very first principles driven. But I'd say there's a few things we tend to like and look for. We like small fund sizes. It makes venture math easier to underwrite. We like investing early stage. We tend to like people who can write a lead check, or there's an opportunity to lead around. And managers have to have some point of view, whether it's on portfolio construction or some unique vantage of like how industries are shifting or what they're looking to build. There's some kind of through line of like why they're doing this. Because again, like our earlier points, like everything can start to sound the same. So we're looking for kind of unique's a bad word, but like kind of specific angles managers have, either to connect with founders, win founders, or add value in certain areas, niche areas of the market. And we've been backing emerging managers really since the beginning of TIFF. It's really core to what we do. So those are kind of the fundamentals. I think right now too, just in terms of like an interesting time in venture capital, like we're seeing this cottage industry really professionalize in a real way. And like what I'm seeing is like there's this big barbell. Like you have these platform firms that have institutionalized, and I think the stat I saw last year is like 70% of the capital sits with 30 managers.
Yeah.
Which is crazy. And then on the other end, you have more small funds than ever because the barrier to entry has dropped. Like it's 20 years ago, it was pretty hard to even create a fund. And now you have institutional angels, you have all sorts of people in that early market. And I think 70% of funds fall below like a $25 million threshold.
Are there conversations you have to have with your clients on why you're focused so early, and any misperceptions or sort of favorite stories you end up having to share with your clients to bring them on board this strategy?
You know, I think it's been such a hallmark of TIFF for a really long time of backing early managers at the beginning of their life cycle. Definitely within venture, but also in our private equity portfolio as well. So we do a lot of direct deals with independent sponsors and have a whole kind of product centered around that. And independent sponsors are literally at the earliest stages of building. Like to give an analogy for the venture world, it's like they're at the pre-seed seed stage. So I think it's been a hallmark for TIFF and how we've used our expert networks, our board, to really find unique people early in their business building career and generate high real rates of return, and also compound that relationships over really long durations of time. So, so I think we've seen that kind of across the TIFF portfolio, both in venture and in private markets.
What does a typical sort of relationship look like in terms of commitments or fund sizes? Like, how do you grow with these managers?
Yeah, I would say, broadly speaking, and to use our direct strategy, we'll do deal by deal with sponsors, and do 3, 4, 5 deals with the sponsor. And then when they're ready to raise a fund, we've already done all of our manager diligence. We've underwritten the deals alongside them. So we quite literally know pretty much everything you could know about them and their deals and their investment philosophy and be really early and high conviction into fund one and write a bigger check. So that's how we've approached it on the private equity side. On the venture side, I think it's about spending time early on with GPs. And again, trying to unpack them and unpack the strategy, the process and philosophy to gain conviction for the fund. And we're institutional LPs, so we really try hard to underwrite for decades and not years or just one fund. So not that we have a hard and fast rule, like once we invest, we are in for, all the rest of the funds, but that's kind of like...
It's on you to mess it up.
Exactly. But we're looking to build really long-term relationships that we can compound with. So,
I think to that point, I would love to hear your perspective on when you're approaching as a fund manager, an institutional investor like yourself, like there are different ways you should be doing it. When you're thinking assume like taking your time, showing your full, like, hey, this is the vision. Are there other kind of things you're looking for to see if someone actually has what it takes to be a long-term fund manager and not just a long-term investor?
Yes. Well, it's so funny. I feel like GPs forget that they're also building businesses. It's so funny. I don't know. I feel like that's like the biggest quote unquote mistake that I tend to see is like GPs just being so focused on one deal or just one fundraise, and they're not thinking long term about building an enduring business. Where I think you see more of that on the when you're meeting with entrepreneurs, but GPs are entrepreneurs. So I think like what really differentiates fund managers and GPs early on is like you can really tell when folks are being thoughtful about not just like the first fund and who they're going to raise money from, but like how they're building the business. Both, it's a marketplace, like both with founders on one side and then your LPs on the other side. And they both matter and they both are needed to kind of build something that is going to last like 20, 30 years because these funds are really long. So I think thinking about that along with how you build your team is quite important. And differentiating early on too. Like you can really hear it when a GP has a why. Like I think a lot of, like going back to my experience with consumer founders, like most of that, like why they build something is born out of like a passion or a really extreme personal problem. This industry, not everyone does that. So like a lot of like, you hear a lot of whining, like, oh my gosh, my carry got cut, or like it's all like economic based. And I think the people that build the best enduring businesses have, like fund businesses, have a real why for why they're doing it. That's, yes, it's financially oriented, it's the business model, but there's also other components to it as well.
With 30 and 40 somethings actually realizing they're adults and history showing like in the past people look to them for new playbooks, where do you think this goes 10 years from now? What does venture look like? Is there a venture middle class? Is it just even further smaller and there's like the top 10 firms have 90% of the capital? Where do you think things are going?
I go back to this concept of GP talent density. Like, I think venture is an industry where very few companies matter, but I also think very few GPs matter. And like on our end, we need exposure. We need to make sure we're getting exposure to those, decade, those compounders, like the companies that matter, and then we get that through the people who matter. And I think it's going to be an interesting decade, because I do think with this generational shift, more people, like, there's a lot of reasons to go do it on your own, and not sit in a structure that doesn't work for you. But at the same time, I think with all the capital that's going to continue to come into private markets, I don't see that changing over the next decade. I think it's only we're going to have more capital and more companies staying private longer. Like, if you're the best in class CEO, why go be a public market CEO? And if you can charge really expensive fees as a manager, why let those companies go public? So I just think things are going to be private longer, and I think there's a structural component to it. So I think it will allow kind of the larger, later stage firms just to become more professionalized and institutionalized as that has continued. So I think it will become bigger on that end, but I think there will be other kind of institutional dynamics that happen in that category. And then I think you will see a continuation of more emerging managers, but maybe with like less like duration. Like, they might not all, they won't all last beyond fund 1 and 2. So I think those that kind of break out will become the new middle. Like, I think in this barbell world that we're living in right now, like, there's like, I feel like everyone in that $500 to $1 billion fund size is like lost. So I think like the next crop of emerging managers will grow into it. So I don't know if that specifically answered your question, but I think if you want to make high real rates of return as an LP, like, all the data shows you need to be early with specialist managers earlier in their life. So I think that's where we're going to continue to spend most of our time.
I love that. And find the champions. So
Yes.
I get it. Yes.
Yes. And do the work, and like the network driven work to find who's going to be the breakout star in that cohort or in those cohorts. So
Cool. Well, thanks so much for being on, Elizabeth. We've really enjoyed your insights, and I'm sure people will be reaching out to chat with you and find you on the interweb. So thanks for being on Swim with Allocators.
no, thank you so much. This is so much fun, and I loved the conversation. So I had a great time. So thank you.
Thank you. See you later, allocator.
After Portfolio Tile, investing with a smile.